Hi, it's Nash from Alpha Phi. In the last video, we talked about how small of a policy you can take out and practice infinite banking. So we previously looked at a 50-year-old male and what those limitations are, basically at that minimum base face amount of whole life insurance, that minimum amount of death benefit given the health rating that you can take out a policy on, and then of course you can add in PUAs on top of that. In this video, we're going to look at a 25-year-old male to show you how that differs with that amortization of expected payments over a longer period of time, and how that changes not only it doesn't change the minimum base face amount, but what it does is changes the minimum base premium contribution limitation. So this will allow you to get an understanding of, hey, kind of where am I at in my life, and what would be such a small policy that I can take out for whatever reason. It doesn't always have to be some very large policy to practice the concept or do some legacy planning and that sort of thing. So we're going to dive right in. So on the top here, on the top left, I have the 50-year-old male limits, and on the bottom I have the 25-year-old male limits. So let's recap. The limitations here are with the minimum base face amount of whole life insurance. So, as a 50-year-old male, the minimum amount of whole life death benefit you can have with a preferred plus health rating is $250,000, with a preferred rating is $100,000, with standard or rated ratings $25,000. With the 25-year-old male, the limitations are the same. However, if we hone in on the minimum base premium amounts, you'll see a large difference here, almost half. So the reason that is with this Guardian product, the L95, they're amortizing those payments, or expecting the amortization of those payments, between current age and age 95. So it's not exact, but you kind of see how it's spreading it out over a longer period of time. That's why the minimum base premium is lower. Then, if we're doing a 10-90 split, meaning 10% of your money going to base premium and 90% or more going to PUAs, with Guardian you can 10 times the amount of your base premium into PUAs, so this number is 10 times the minimum base premium, and then you add the two together to get your total funding maximum target. So this is pushing right up against that MEC limit of not only the minimum base face amount or the whole life death benefit, but also the target additional benefit or term that we add to effectively and efficiently raise the death benefit, to raise the MEC limit, to allow us to put in so much money into the policy. So much different limits here in terms of funding. And again, this is at a 1090, so you don't always have to do that. This is what I normally talk about because I think it provides the maximum amount of cash value and liquidity, maximum amount of guarantees, and maximum flexibility for clients. But certainly you could do a different contribution into PUAs that would be less as compared to your base premium. All right, let's look at the numbers. So this is one of those minimum policies with that hypothetical 25-year-old male with a 10-90 split and comparing a 30-70 split. So looking at the two side by side, we have our minimum payment here. It's the exact same because we bottomed it out, and the minimum payment is not only taking into account that $300 and I think $24 of base premium, but also the minimum amount going to the scheduled PUA rider on Guardian. The scheduled PUA rider minimum is about $250. It could be more than that depending on how big of a policy you're talking about, but the minimum is $250 to allow you to keep the PUA rider attached. It also covers the 1-year term cost. So that's essentially the minimum, covering that base premium, keeping the policy alive, as well as keeping that PUA rider attached. So that's what I call the minimum, or the bill, if you will, that you'll pay on your policy anniversary date if you elect one-time per year payment, or you can do semi-annual, quarterly, or even monthly spread out payments. But essentially that's the bill. The target payment means the total amount that you can put in flexibly. So above that 573, you have the ability to fund in at your leisure $3,560 on the 1090 and $1,080 on the 3070. And let's compare here. So on the we have the guaranteed column on the net cash value and the dividend values on the right here in blue. So let's look at it. Target payment, if you put out about $3,500, you'll get almost $29.59, or you will get $29.59 in cash value that you have access to. Immediate liquidity within 10 business days if you want to take a policy loan. Really, that 10 business days is just waiting for the bank transactions to clear. That's essentially what it's for. You can even speed that up, and I've had clients who really want to cycle money through quick, and they can provide a bank statement and get access even sooner than those 10 business days. So 83% coming back to cash value in year one. This is with the normal PUA rider. You can also choose the short-term performance PUA rider, which would give you another 5%, which would bump you up to 88% or so in cash value in year one. The reason that there's a trade-off there, of course everybody would take that liquidity if there wasn't a trade-off. Really what that option would do is give you more liquidity up front, certainly in year one and through year 11, and then it would start to fall behind the normal PUA option. So the difference there is that Guardian is saying, hey, if you give us access to more liquidity for our working capital, we will put it in our general investing account and generate larger potential returns, or we can give it to you up front and we will generate lower potential returns because we have less to essentially invest and distribute back to policyholders. So that's the trade-off. Breaking even out here in year 5, or between years 5 and 6 rather, and then continuing on. So a total of $24,930 out of pocket out of 7 years. RPU in year 8, the IRR and the efficiency of the policy is maximized because we're cutting all the drag and fees off of it, and then it's just pure growth from there, and you see this continuing to compound and take off at an exponential rate. You can see that here in the year-over-year cash value growth. That number continues to grow because of that compounding. So let's look at age 65 here. We started with the 25-year-old male. So $24,000 total out of pocket by age 65. You have $124 in cash value, $206 in death benefit. By age 85, we have $281 in cash value, $328 in death benefit. All right, and then the 30-70 split. So jumping through here, the outlays are different because we're having that minimum base premium, just different amount going into PUAs. So only $7,560 out of pocket. Total over the 7 years, with $1,080 out in year 1, you have $697 in cash value, so 65% coming back that you have access to within 10 business days. A much larger liquidity hit because that larger base premium, there's more expenses and fees generated with that larger base premium. So it's a larger hole to come back from, and that's why the break even pushes out here to year 8. And then the guaranteed break even out here in year 13 as opposed to year 9 on the 1090 split side. You'll notice when we do the RPU, because we're cutting off the base premium and the need to pay for that, the IRR is about the same. It's just on a lower number, so it will lag. So with 7,000 only, 7,560 out of pocket, let's come down here and look at those key age milestones. So 55, 60, 65. So let's start with 65, right? So 7,000 out of pocket, 34,000 in cash value, 57 in death benefit. And then by age 85, we've more than 10x'd the money, so about 7,000 out of pocket, remember, and you have 78,000 in cash value, 91,000 in death benefit. So quite a powerful tool over time, even with different splits going into the policy. Definitely able to do this with smaller amounts of money, and if you have a desire to do so for different purposes and generating some legacy planning. I hope this was helpful, understanding the minimum limitations, and let me know if you have any questions. Please like and subscribe, and I'll talk to you soon. Thanks. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.